Good afternoon. Welcome everyone to join our webinar. And the webinar today topic on the global market outlook with a Hong Kong and Canadian tilt. My name is Mary Ann. I am the co-chair of the Financial Services Committee and an active member of the Canadian Chamber of Commerce in Hong Kong. Canadian Chamber of Commerce in Hong Kong is a nonprofit, non-governmental organization that was created in 1977. And to date, we have more than 1,100 members, representing nearly 300 companies. This makes us one of the largest Canadian business organizations outside of Canada, and one of the most active international chambers in Hong Kong. For those non-Canadians listening in the webinar today, it is important for you to know that we are an inclusive and diverse community. In fact, about 40% of our membership is non-Canadians. So everyone is welcome to join our organization. And to share a little bit of what Canadian Chamber of Commerce does, we deliver 4 services to our members. 1, representation and advocacy of engagement. 2, business promotion, networking, and brand exposures. 3, learning and training, and lastly, information and insight. And today, we are bringing you a conversation between FX and macro strategists. Today, we have Patrick Bennett and CIO Willie to discuss the current state of interest rates, foreign exchange, equity, real estate markets, and the market outlook moving forward. Both Patrick and Will have more than a decade worth of experience working in Asia. Patrick has spent most of his years working between Singapore and Hong Kong in Europe's largest banks. And Will, with the leading Chinese companies to raise capital in global financial markets. Both Patrick and Will, I welcome you to join with us today. As a bonus, we will be holding a lucky draw for today's webinar. The winners, one of members and non-member, we'll have the opportunity to have lunch with our speakers today at the Hong Kong Club. We'll be announcing the winners of our lucky draw at the end of the webinar. So please stay tuned at the very end of our webinar. I'm going to quickly introduce our speakers today. Patrick, who is the head of FICC strategy at CIBC at Asia Global Markets. Will Lee, who is the PM and CIO of Arete Capital. And myself, Mary Ann Tsang, I am the Managing Director, Head of ECM for China Merchant Securities. So quickly, with the outlook of a setup, later on we are hoping to discuss more of macro strategies, global market outlooks, our views across asset classes. I'm going to pass the webinar over to Patrick and followed by Will, to introduce themselves, share a little bit of a summary of their view of the market, and then we will hopefully to have very engaging and stimulating conversations. Patrick, please.
Yes, thanks, Marianne. Thanks to the Chamber and thanks everyone for joining us today. Marianne said my name is Patrick Bennett. I lead the fixed strategy, which is fixed income, currencies and commodities strategy effort here for CIBC here in Asia. Our goal is to bring Canada to Asia and Asia to Canada. I've been here a little bit longer than the 10 years. I've been in the region for now just over 25 years. I've certainly seen some ups and downs in that time, and I'm sure there's going to be some more. And what I'd like to do is look at those as opportunities, looking at the same set of factors that we all see, but looking at sometimes from a different angle. That's how we work together with our clients and how we work to deepen our relationships with our clients and to find solutions for them. What I'll go ahead and do is give some introductory remarks of how I see the market setting up at the moment. But of course, very interested to hear and to answer questions or queries that people joining us today may have. Of course, it's easily tempting, or it's very tempting to say that we live or remain in very interesting and challenging times. There's no way I would dispute that. I don't think there's anyone out there who would dispute that as well. Though certainly we consider, we're almost in the midst of times where there's a great deal of angst and hand-wringing over events and news. I mean, the pandemic lockdowns, a terrible disruption to people and ways of life are undeniable. But I think those now, somewhat being damped by a rollout of vaccines. That's not been smooth, but certainly we're seeing progress in that nonetheless. On the other hand, in markets, we find ourselves drawn to news, and I'm just thinking of what we saw in the last couple of days of a family office being forced to sell an equity holding. It's funny, well, not funny really, but 20 billion or 20 billion is a number being thrown about. When I was reminded by one of my colleagues here this morning that it was $4 billion was the amount of LTCM back in the late 90s, and that's somewhat sobering that we've moved on quite so far in that. We're looking at a ship stuck in the Suez Canal. I know that's been released now, and others, but the markets sometimes look at these things as potentially systemic. I don't believe they are. I think they're a reflection more of a short-termism, if you like, and a huge degree of liquidity in the case of the family office, and of markets that are down to looking for a faster exchange of information. I would say that through it overall, it's probably, we cannot deny that the global central banks have in the vast majority of cases stepped up to backstop economic activity, and I think they've been successful in that. If we think about forecasts for GDP growth this year, after a very terrible 2020, the forecast this year simply stunning. We're talking about US GDP of 6%, and that's perhaps the low end of that, 4% next year. Canada at 5% this year and 4% next. And in fact, Canadian GDP in particular has surprised expectations over the last couple of months. The next release is tomorrow evening. We're looking for around 0.5% month on month. That would be another great result. And I think in this case, there's a number of data prints where there's a desire to look for faster and more timely indicators. The traditional focus of looking at a number which has gone before may have passed it into history, but certainly now the impact or the issue for markets and for all of us looking for investments now and in the future is the uncertainty that remains regarding the impact of various or ongoing waves of virus and lockdowns which are associated with that. But when we look ahead, and I mentioned those GDP forecasts, an issue for me is that I'm not comfortable at all really with this. What a prevalent idea there is of being a huge amount of pent-up demand in the global economy. Employment in many sectors of the economy has cratered, services especially. Recent Canadian employment data was much better than expected, but still at 8.2%. It's well shy of where we were the previous neutral levels, and it's still flattered by the definitions which are used to calculate that, being those not looking for work or those to re-enter the count. So the bottom line I'm saying for that is to assume that once people regain employment, and there certainly will be some who will not, their propensity to save or spend, I'm not really convinced that they have a higher propensity to spend as may be thought. So I think that's some way underappreciated. So the way back for the economy, I think, is still mired in some uncertainty, and such that central bankers in Canada and elsewhere express their commitment to keep rates low until employment and hence wage demands return, and that's going to be some time away. And we expect the first rate hikes in Canada and the US to come by late 2022, but I think the market risk is that they're somewhat later. I would say it's been the case recently with central banks. It's been the tail, and I call that the market wagging the dog, which is the central banks. So the tail, the market has been imploring the central banks to be raising rates sooner than they would like to, fearing for inflation and what should happen if that's not going to be addressed. But now we have central banks that, they target inflation. We have the Fed's average inflation targeting, rather than looking to cap inflation. So I think, these fears of inflation, I think, are overcooked at this stage. Post 2008, 2009, we had the same fear of inflation. They were proved unfounded. Excess capacity stood against that occurrence. And I think forward to now, without having achieved that inflation yet, the market, in its wisdom, has simply replaced the IN at the start of inflation with RE, talking about reflation. So I do think we're on track to return to sustainable growth, but I'm less inclined to fear inflation and talking of inflation. I'm really more talking about CPI rather than financial asset inflation, because we've had financial asset inflation has been with us for quite some time. And while liquidity stays in the global system, that's not going away anytime soon. So talk of tapering of asset purchases, I think, is valid from central banks, and I expect we'll hear more of that from the Bank of Canada soon. We expect them to start to reduce their purchases over the next couple of months. But it's incongruous to have yields so low at this stage. Real GDP plus inflation expectations and a risk premium simply can't get us to that level. So the extra ingredient in there for the market is this extraordinary monetary policy. And as we've heard, that that isn't going anywhere anytime soon. So sort of to wrap it up, overall, my outlook is for positive growth that remains supported by central bank liquidity, that in turn supports assets and activity. Bond yields, I think, will remain somewhat elevated, but only versus the previous levels. Central banks are not going to allow a deflationary environment. Fiscal spending is important. It's been a missing factor for some time. I'm not sure it's conclusively begun just as yet. Talk of effective stimulus, say in infrastructure spending, has been a long time coming. In Canada specifically, stimulus plans are, in contrast to the US, are over a much longer period and as yet are less defined. We're talking about 3 or 4% of GDP, whereas in the US it's 9% just for the 1.9 trillion. In Canada, again, debt will rise to 95% of GDP, but demand has not been in doubt, and nor do we expect that's going to be. The IMF criticism recently of this fiscal anchor, I think, should be addressed by the finance minister in the budget on April 19th. In other markets, equities are seeing some rotation, out of the tech-heavy favourites into some more, real economy and growth stocks. Valuation of a number of instruments, is coming under scrutiny. But again, with GDP growth elevated, it's not easy to make a case for an index collapse. Closer to home, China led the way in the recovery, and I think it's going to continue to do that, as we go forward, from this point. In terms of currencies, when we look at the Canadian dollar right now, present levels indicate some relative strength, and one area that has been achieved in is a correction to the current account deficit. This is especially in earnings of Canadian overseas direct investments, and that's versus the payments that Canada is having to make on its bonds. So that is one factor which is keeping the currency somewhat stronger than it would otherwise have been. But ultimately, we see CAD reverting to a low vol trade on the US. When the US lifts, Canada lifts, and when it hurts, so does Canada. So in summary, we're expressing confidence that economic recoveries and central bank liquidity will remain. Higher bond yields are welcome, but far from concerning. Equities can continue to look rich, but rotation is happening. Canada has challenges regarding unemployment and putting fiscal stimulus to work. And I think if we look at China and very closely what they did in the two sessions a couple of weeks ago, looking to partner with China in new R&D and investment and participation in schemes such as the Wealth Connect that we're hearing more about from China, interesting positives on the horizon that I believe that Canadian businesses would be well placed to position for. I'll leave it at that and hand over to Will and look forward to some questions and comments to follow.
Will, please.
Yeah, thank you, Marianne. Thank you to the Chamber of Canada, Chamber of Commerce of Canada. I would apologize. I know very little about Canada. I do have a very favorite jacket, which is from Canada Goose, but it's really extent of my knowledge of Canada. My apologies. My background is that I grew up in China and then went to study in the U.S. Really studied a lot of economics, and then after graduation, I became a banker, a corporate finance banker, which is what Marianne referred to. Leading Chinese companies to the public markets. But that was my previous life. Over the last 9 years, I've been running macro hedge funds. So we've been running a macro strategy that focus a lot on on China, and then also focus a lot on the kind of unprecedented, monetary and monetary environments, in the world. Obviously, a lot of things are unprecedented nowadays. Negative to low to zero interest rates, globalization, the world moving from a kind of a unipolar world, after the fall of the Berlin Wall, to a more kind of multipolar world. There's convergence, there's divergence. When we today, I was asked by Ted to be kind of provocative, right? So I want to draw some views and approaches that hopefully are thought-provoking. That's certainly these are not, a lot of these are probably not our base case views, but really just to help to frame some of the issues that we're looking at. So when we think about the kind of a lot of these things are unprecedented, a lot of things that are fast moving, right? I mean, I think it's a lot of times the way I want to look at it is to really look at the essence of things, right? You want to look at the fundamental, the origin of the study of economics, right? So when I started taking economics in school, the first couple of things that we all learned is that economics is the study of scarcities, right? And then the other very commonly repeated refrain is that economics is a dismal science, or a kind of a miserable study or miserable pursuit, right? So when we think about that, I mean, that leads to my next kind of a question, which is I mean, when we look at the world today, policymakers, right? By far the two biggest important things that policymakers, central bankers focus on, one is on growth, right? The other is on inflation. And when we talk about inflation, it's consumer inflation, right? When we look at what makes up consumer inflation, right? You look at the baskets that measure consumer inflation. A lot of these are really subsistence goods, basic food, basic clothing, communication needs, basic, kind of rents, that kind of stuff, right? So the question is whether these things are still scarce, for a lot of the economies that we deal with, right? You would think that, just generic food, generic clothing. I don't want to sound callous, right? But for a lot of the economies we're looking at, developed markets, places like China. These things are no longer scarce, right? I mean, so that leads to the question whether the singular focus on consumer inflation is still justified, right? I mean, it's sort of like drinking clean drinking water. For a lot of the societies in the world, clean drinking water is still precious, and it determines your life expectancy and the economic activity. But for a lot of the stuff we have in the consumer baskets these days, they're no longer scarce. We have GMOs that really produce a lot of food, a lot of cotton, right? Technological advances are really driving down communication costs at a very fast clip, right? Probably faster than the CPI index can reflect, right? So if we're not if we shouldn't focus on just consumer inflation, then the question is why, how about asset inflation? Patrick, alluded to this. I mean, there's clearly a lot of asset inflation, over the last couple of decades, and then I think the kind of a fundamentalist view by central bankers that they shouldn't tamper with it, right? They should, just focus on, controlling the post-mortem, right? Famously said by Greenspan. But when we think about why we, want to focus on controlling consumer inflation, right? Clearly, one reason is that it affects livelihood. But the other reason is that, we have, inflation that's kind of out of control. It's hard for economic planning, right? Corporates, can't, agree on wage, increases, for example, with their employees, if the inflation expectations are out of control, right? So, but when we think about asset inflation, asset prices certainly have just as much bearing on real economic activities as, probably consumer inflation. When you look at your home prices, your portfolio prices, when startups, try to hire people, by really rewarding them with mostly options, right? So these are all, how I think, asset prices really affect economic activities, right? The clearest example of that was in 2008, that subprime crisis, right, was really stemmed from a collapse in asset prices, right? So that led to a major recession that we experienced over the last decade, last half a century. So whether we should look at asset inflation and how we should take that into account, that's a key question, right? And clearly that new things need to be looked at, right? And then finally, when we look at why is there a lot of asset inflation, right? There's a lot of capital, I mean, yields are very low, negative, and when we think about where does this a lot of this cheap capital come from, right? I mean, partly comes from a lot of savings. Partly is because we're borrowing from the future, right? Future generations, from our posterity. So by borrowing a lot of cheap capital from future generations, and then we entrust this capital to a small circle, of people, and that lead to asset inflation. I mean, just cheap capital just lead to asset inflation in general, which exacerbates one of the major problems of the world today, which is inequality, right? People talk about gender inequality, we talk about racial inequality. I mean, the other key thing that I don't think we talk about enough is intergenerational inequality, right? Basically, older people like me, right? People with assets, right? That we're sort of pulling away further from the younger generations, because there's a lot of cheap capital, and that really inflate asset prices. So I'll just go out on a limb and say venture. You really just for playing devil's advocate, right? And also just throw out the same thing for discussion, which is that a lot of the when we look at the fundamental goal of the study of economics is really to reduce human misery, right? And so I would say a lot of the misery right now is probably not coming so much as of people starving, people freezing to death in a lot of the economies that we're dealing with, right? But it's really from inequality, lack of upward mobility, and all those stuff, right? And you would think that the policies on one hand trying to a sewage, reduce suffering, poverty, but on the other hand maybe exacerbating some of the issues, and that is clearly I think the foremost challenge for policymakers today. So that's my preamble. Really just to throw out a few things and to be thought-provoking, and really looking forward to your questions. Thank you.
I think I'm going to quickly jump in and think, since that we're trying to get this panel conversation a lot more conversational, so I'm going to throw it out there for the audiences to understand that the views and opinions of our discussion today will be a 100% personal view, personal opinions, and those do not represent the firms that we are currently employed by. Just to throw it out there as the disclosure. But I want to quickly go back to what both Will and Patrick have alluded to quite frequently earlier in the last 10 minutes, is the word inflation. And both of you also mentioned about the CPI component. We are looking at the inflationary environment under the consumption spending. But I would like to throw this to both of you and check whether your view, what would be your views on this. Currently, with more of an official calculation of CPI, Consumer Purchase Index, do you think the calculation or the index itself is updated? Is it relevant? Why I ask is because earlier Will did mention about a lot of prices, i.e. in terms of how we live nowadays. We do a lot of cross-border economies, a lot of online purchases, a lot of e-commerce, and we also do a lot of free Zooming. Transportation, we have a shared economy, Uber, the likes. Office rental, we actually share the office rental right now. It's in the like of a WeWork. Are those actually included in the calculation of CPI? If not, what does that mean, or what does that imply to our understanding of CPI? So the question to both of you, please. Feel free.
Yeah, it's like, well, perhaps I'll go first, but I'm sure Will has opinion also. It's like, how long do you have on this one? Look, I think that the calculation of CPI at the moment is flawed. Yeah, absolutely. I think if you look at some of the components in the official basket, they just don't really relate. I think if we ask some of our colleagues or, or family or friends, if they're paying more for things, people would say, yes, look, I'm paying more for education, I'm paying more for medical services. Some other things are cheaper. Flat screen TVs and mobile phones are cheaper, but the world has got greedy. People want 2 or 3 of them now, not just one. So, yeah, look, I think it's hard to measure that, and financial assets, have certainly appreciated. And I think that perhaps the market is looking incorrectly at this view. If they fear inflation, then I don't think that they're looking at the right assets, to position for that. Because real assets, things like real estate, but believe it or not, real estate has really underperformed bond yields, or has underperformed bonds, has underperformed stocks. So if we wanted to hedge against inflation, the fear of inflation, then real assets, should be more demand. We should be looking more at real assets, commodity assets, industrial commodity asset, industrial commodities. I think have also, they have also underperformed, bonds and stocks, to this point. So I think there's still a room for that to rebalance over the next few years, regardless of the fact that I don't think we're going to see official measures of consumer price inflation, start to push through the top of these target bands. So to answer in a short way, I think the measurement at the moment is flawed. I think it needs to change, but I think there is some opportunity to to position for this fear, somewhat more proactively than has been done at the moment.
Yeah, I totally agree with what Patrick said. I think the other thing that's kind of a problematic is that with rapid the acceleration of inequality, right? So you can say for a large swaths of society, the stuff that's still in the CPI basket is still very relevant. But for other part of society, that's no longer that relevant. When we look at advanced societies like the U.S., Canada, you really don't see people starving. They're homeless. But that's I again start to be generalizing, right? But the lot of that probably has to do with psychological issues. So when we look at what really troubles people, you do see kind of a reducing life expectancies, right? You see suicides and all that same stuff. Even before the pandemic, a lot of that really has to do with loss of jobs, loss of upward mobility, and how to give people hope, right? I think that's the key thing. And it's interesting also to contrast, how China deals with it. China certainly has a very different governance system from the Western countries, and it's never, China has never been kind of a coy about dealing with asset inflation. When we look at all the plethora of measures and the Chinese government has put forward to control home prices. Part of that has to do with the large amount of monetary and fiscal stimulus that have been deployed, but also it just really brings to the fore the necessity of having the need to deal with asset price inflations. The way China's the less that when you do too much stimulus, asset price bubbles can really distort and disrupt healthy economic activities.
Thank you. And earlier, we did also mention about another way of looking at inflation is that the current generation is borrowing from the future generation. And I was glad to find what Patrick has highlighted, that the return of real estate assets have underperformed those of other assets, which is good in a way. But in terms of a more general view, what do you think that we are doing right now will imply for our future generations? Either they borrowing from future in terms of cost, asset inflationary environment, unemployment or employment issues, opportunities, silly from going up, upward mobility, etc. Would you like to elaborate a little bit more on that too? To both Patrick and Will?
Yeah, look, I would say, borrowing from future generations. Look, of course, I mean, that's what, interest rates, that's what borrowing is. That's capitalism, isn't it? That we borrow, at interest rates because we believe we can, increase productivity and increase our income over that period with the use of that new capital, by the way of borrowing. And it's interesting right now that interest rates are very, very low. They're kept artificially low through extraordinary monetary policy from global central banks. And we have economies this year, and I alluded to this earlier. We have, the US economy this year may grow at 6%, may have the Canadian economy grow at 4 or 5%. And interest rates which are considerably lower than that. So if I was a corporate treasurer and I'm looking to borrow money to invest in the economy, then this seems like the ideal time to be doing that. That's not happening quite so much because credit standards have been impacted somewhat by the fact of this uncertainty. So look, I think, how does it impact the future? I think some things we need to look at. We need to look at in terms of working hours. I alluded to earlier that people have become, or that greed has become something which is a bit prevalent. 2 or 3 mobile phones, or 2 or 3 or more flat screen TVs, and maybe we have to go back to slightly simpler times. I'm not sure we're going to see that happen. We have incredible technology advancements now which are making things easier and more accessible, and maybe it's time to think about more leisure time for the future, rather than constantly chasing these financial assets. So I'm looking for a rebalancing between real assets and financial assets over the next this is probably a 5 to 10 year story.
Yeah,
I'm going to yes, please go ahead. Will, apologies.
Yeah.
Please go ahead. Please.
Yeah, no worries. I think I agree with what Patrick said. I think the other key thing that we want to think about is that these low interest rates, negative interest rates, right? These are very blunt tools, right? So they essentially flood the economies with liquidity, and it's not necessarily going to people or segments of society that need it most, right? So and we're going to see more and more kind of administrative fund targeting of stimulus. We see that already in the U.S., right, with the 1.9 trillion CARES Act 3, right? So out of that 1.9 trillion, 80% or more is really going to people who need them, right? I mean, these are people who are the $1,400 per person checks, the unemployment benefits, the child care credits, right? So rather than just keep interest really low, and then so people can lever up, and obviously then disproportionately benefit people who have the ability, who have the access to capital, who have the assets to offer as collateral, right, to lever up. So more finely targeted directing of the stimulus is much more needed. On that front, also I think China can shed a light on the necessity of that. As we in China have really build up the world's largest broad money supply, right? And the need to initially fund target and direct the liquidity to where it's most desirable for the liquidity to go to is ever more pressing. And you see that there's a lot of tools and the Chinese government has already deployed, which obviously it's probably only doable in China's governance system, but for the West, I think one thing that can really periodically check the kind of a unbridled kind of a capital leverage, right, is really what we've been seeing over the last couple of months, right? You saw this this block trades that happened a couple of days ago, and in January we had the short squeeze, right? When you have a lot of capital in the system, and capital always go to the extremes, right? They go to the upper limit in terms of trying to generate yield, and then you lead to quality positioning, and this it starts an iterative process where introduce the volatility, in what we call Indulgence Risks to the financial markets, which will drive up volatility, and that will necessarily drive up the cost of capital, and then check, right, limit the kind of headlong rush to take on leverage.
I'm going to quickly jump because I see there were a number of questions that popped into our chat box in the last few minutes. So in the interest of time, I'm going to go directly into some of the questions and we can discuss off the questions from the audiences. One interesting question I think I would also like to find out is that we have seen significant volatility in the first quarter this year. For the panelists, how do you think for the rest of the 2021 and going into 2022, the asset classes, global asset markets will perform? With that, for the interest of our audiences as well, how will our panelists view the investors, individual investors in particular, should protect ourselves, our own wealth against asset price inflation? Would you have some views on those two questions, please?
Yeah, well, I'll kick off. We'll keep it in the same series. Look, volatility, yes, there has been some. It's certainly intraday, probably more than sort of intra-month volatility. Markets are still at, asset markets are still at quite elevated levels. But I think the volatility that we will see over the next 6 to 12 months is as economies continue to recover, and as they are forecast to do, I think we're going to start to see some divergence in that. So at the moment, it's been, the rising tide has lifted all ships, apart from the one in the Suez Canal, of course, and that's helped all economies, start to recover from a sharp downturn last year. But I think as we go through this year, I think we're going to see some more divergence. I think the US will outperform many of its G3 or G7 rivals. I think Asia, as an emerging market, remains strong. I think there are economies which are pro-cyclical to global growth. And in this case, I'm talking about Canada, Australia, New Zealand, the commodity block that we think about, who will outperform. So I think the volatility that I'm looking for or looking to hedge against is that which comes from a more divergence of performance. And I think that's the same, when we talk about divergence of performance between, say, the tech stocks and the growth stocks that we're seeing now. So yeah, I think it's time now to think about that divergence. I think it's time now to consider whether this rotation in asset markets is correct in terms of hedging for the fear of inflation. And again, I don't hold to the same fear that the market has right now. Then I think real assets versus financial assets are going to be the way to go.
And Will, as the Chief Investment Officer, looking at macro assets, cross assets, global strategy, what would your view on that too? How would you position, or how would you recommend some individual investor to take opportunity of the current volatilities?
So one of our stronger convictions is that the cost of capital will increase. We may be at a secular inflection point. When you look at last 3 decades, right, since Paul Volcker broke the back of inflation in the late 1970s and 1980s, interest rates have been on a secular decline. Now we're at a point where we think we could be inflecting upward. When we think about cost of capital, part of that is really interest rates, right? So when we think about interest rates, clearly short-term interest is kept very low by the central banks, and the central banks can even go to controlling the back end of a yield curve by yield curve control, right? So when people think about interest rates, the first thing, almost like a lot of times the only thing they think about is consumer inflation, which is why I brought up the idea just a while ago that that maybe we're talking about cost of capital holistic, right? So interest rate is only part of that. And when we think about what's cost of capital, it really goes into risk-free rate, which is the interest rate, short-term rate, and then there's also volatility, right? So even the central banks can artificially keep the risk-free rates low, but they can control volatility. And in fact, a lot of times the volatility will implement discipline, right? When we think about the 2 major events of volatility so far this year, right? One is the GameStop short squeeze. GameStop triggered short squeeze, right, at the beginning of year, and now we have this deleveraging and that episode, and then the other source of volatility is really the very rapid rise of rates. In 10-year, went from 1 to 1.7 literally in the span of a few weeks, right? So when you think about all these things, right, I mean, really these three events all came from extreme positioning, right? And extreme positioning, shorting once a small group of stocks, extreme positioning in terms of long a very small group of stocks, and then on the interest rate front, it's really extreme positioning in terms of believing, right, that interest rates will stay low for forever, right? So these are not like there's not exogenous shock like a new virus or a geopolitical event, right? It's really just the market itself that because of extreme positioning. This is what we call Indulgence Risk, right? So if the central banks continue to kind of foster more hazards by encouraging this very extreme positioning, and the market itself will lead to more volatility, and then necessarily lead to higher cost of capital, right? And then you also have the social needs, really. I mean, eventually when we talk about social needs, it seems to be very longer term, very kind of amorphous, kind of like you can't hardly trade those kind of social events. But when we look back the past few years, right, these social events, whether it's Brexit, the U.S. politics, right, in geopolitics, right, a lot of them can trace at least part of its roots, right, to economic issues. This economic determinism, right? But so it is very pressing to address the fact that cost of capital is too low. I wouldn't say interest is too low, but cost of capital is too low. So when we think about if the cost of capital, if we sort of give the benefit of the doubt, that hypothesis, right, that even though interest rates may remain low forever or for a very long period, but the cost of capital is going to increase, and then that almost necessarily imply that the higher value of growth names, right, growth assets that really really discount its future, derive most of its value from discounting its future stream by cost of capital, but now by short-term interest rates. And that seems to imply, just like Patrick implied, which talked about, which is a rotation maybe afoot, right? And when we think about real estate, that's also very interesting. When we look at again comparing China with the Western countries, China, with a lot of liquidity, the go-to asset is really real estate, right? You see their periodic, kind of rallies in the Chinese equity markets, but real estate is really by far the best performing asset. That's not the case in the Western countries like the U.S., right, where equities have really done well. A lot of that have to do with I think the taxation system, right? So the carrying cost is much higher in the U.S. than in China, and also for real estate, right? Now the other thing is for the governance systems for the listed companies, right? It's also very different. Chinese listed companies tend to, on average, issue much more supply of equities versus U.S. Even though you have a lot of IPOs, but existing companies actually buying back their shares, right? So those are all very interesting to contemplate, in terms of how we perform, in terms of in the kind of new environment that we kind of envision.
And with what you mentioned about the China policies and new directions, and also Patrick earlier mentioned about China's 5-year plan. With the latest China's newly announced a new 5-year plan, do you think there's any obvious takeaways for the Canadian businesses as well as for our audiences online today that may have an interest of both China versus Canada?
Look, I think look from the Canadian perspective and what may be possible. I think the focus on research and development, partnering with investment partners, I think is important for Canada. I think in determining or trying to ensure flow of commodities in the long term, I think there's something there which is to Canada's advantage. I think for the financial sector, I mentioned earlier the Wealth Connect, I think is very important. I think for businesses, one of the challenges for many years has been to get money into China. Now I think, you know, ultimately it's going to be how can we get money out? How can we create this balance of supply and demand? I think we're moving towards that. There probably been some greater volatility in the currency, but I think you know, China is slowly, you know, opening up its current account, and I think with a capital account rather. And I think we'll see more of that. Perhaps on the geopolitical front, I see Bill was asking a question on that earlier as well. That, you know, I think that we've moved away from these, and Will mentioned earlier, moved away from this, you know, multipolar or this, you know, globalization to more, you know, unipolar or you know, diverse groups, and I think that's not really encouraging. But I think we need to, you know, to focus on that, and I think a move back towards a more, you know, multi or more globalized, you know, economy front, I think would be more encouraging. But I'll leave it to Bill to talk more perhaps on the 5-year plan.
Yeah. So you know, I think relation with Canada, you know, I mean, I think, you know, China, you know, last year we wrote out this whole, you know, double circulation, right? So, you know, there's the internal circulation, the great internal circulation. There's also the kind of a, you know, outside kind of circulation. I think China, you know, despite, you know, kind of you know, some rhetorics, right? You know, I think is very much sincere and very much key in terms of improving China's relationships with the outside world. I think, you know, there is a very, you know, wellspring of, you know, grassroots, you know, goodwill and good desire, right? Strong desire to improve China, you know, integrate China further into the world. The other thing I just want to point out that's really interesting in the 5-year plan is, you know, this new phrase, right, on controlling disorderly expansion of capital, right? You know, this is a relatively new phrase that we haven't heard this before, you know, until, you know, sort of like fall of last year. We had to do with the, you know, the kind of anti-monopoly kind of drives by the Chinese policymakers. I think that's another, you know, another phenomenon that, you know, fit into our framework, right, of rising cost of capital, right? When they say they want to control the disorderly expansion of capital, you almost can rate it as a, you know, saying that there's just too much cheap capital running around, right? That you know, can distort asset prices, you know, even you know, make, you know, I guess, you know, go to excesses in terms of certain investments and then disrupt, you know, industry structures and so economic structures that may not be in the longer term for the benefit of for the longer term health of the economy.
If that's the case, what do you both of you think, especially when we are situated here in Hong Kong, a cross-border neighboring to China, also a gateway to the foreign markets, including those of US and Canada. And if we have so much disrupted cheap capital flooding the market, and Hong Kong is still very uniquely positioned, what do you think it implied for the Hong Kong markets and those of us that live here?
Will, or
I you know, I love Hong Kong, and I think, you know, Hong Kong is really, I think it's really becoming, you know, very important gateway, right, for capital to go in and out of China. You know, China still has a relatively unique governance system, right, legal system. So Hong Kong is an important gateway. That's why I think its role, you know, I mean, there was people had thought about, you know, that, you know, a lot of the finance, a lot of the, you know, the capital market activity will go straight to China, and that wasn't that has been a trend that's also you know, very much clear and present here, but also, you know, I think Hong Kong's unique role is you know, is even probably more important and more valued, right, in this kind of world we're in, right, where you know, we're sort of moving from a kind of a unipolar, you know, almost like hegemonial kind of, you know, system, you know, in terms of both trade, commerce, economics, legal, to a kind of a bipolar or multipolar world. So when you have like many poles, you need these kind of a gateways, right, portals that ideas, capital, human capital kind of flow across, right? So I think Hong Kong, I'm very optimistic, very confident about the future of Hong Kong. I think the economy is really going to has a very bright future.
I'm also going to go quickly back to some of the questions being raised by our audiences. Earlier, we did talk about quite a bit about disruption recently, especially with what's been happening with the ships in the Egypt Canal. What do you think with earlier what we talked about also inflationary risks, inflationary concerns? What are the implications or expectations into the global supply chain in your views?
You look, any disruption like we saw, obviously it's pressure on that, and as Will has been talking about, and we spoke earlier, the change from a unipolar or bipolar to multipolar, obviously impacts global supply chains. We've seen a lot of onshoring, if that's the right description, of people trying to shore up their supplies of commodities, their supplies to fit into their chains. And I think China particularly has that as a centerpiece of their goals as well, to make sure there's dual circulation, to emphasize the domestic circulation, to emphasize that they have the imports from from offshore in terms of commodities and other products to grow at the pace they want to grow. And that was at one point, that was the friction between the US and China. The trade tension, the trade tariffs were really a front end to China trying to grow its economy in China 2025, and the US and others saying, well, we don't want you to do it. We would not allow you to do that if it's only going to be by the forced transfer of technology or intellectual property, and the like. So I think there's been some influence of that, and I think that has made a split up of global supply chains. I think it's made them more fractured. I think that does feed into fears of inflation, but I think it's more a one-off impact, or an impact that we can look through, rather than one that I think is going to impact inflation dramatically over the long term. Yeah,
I totally agree with that. I think when you look at last year, right? Despite the kind of tariff, wars, right? China's export had been both exports and imports have been growing, at a very unprecedented, speed, right? So I think that's a global trend, right? In terms of increase the integration of global economies, and we source, very cheaper, foodstuff, grains, edible oil, cotton, from all over the world. I mean, that longer term, that's I think at least for the current consumer basket, is a very kind of deflationary kind of forces, right? Keeping the lids, keeping the prices under control. But the key, I think, it will be whether whether asset inflation or growing inequality, right? When we think about how the tariff war came to be, right? I mean, part of that is really about a group of people that did not benefit as much. They still benefit in an absolute way, right? But did not benefit as much from globalization, right? And then they feel discontent. I think part from inequality, part from losing jobs, partly from having their upward mobility, pass for upward mobility, shut off, right? And that led to kind of a venting, or just searching for alternative, right? Even though there's no clear plan, right? And so that led to tariff war, and then had impact on the economic asset prices, right? So that's a way for kind of inequality to really affect markets, even though inequality seems to be a social problem, but it can be manifested through social, political, and geopolitical developments to affect financial markets and asset prices.
We only have a few minutes remaining, probably less than 5, but there are a few questions I actually personally would like to find out too. So if we could just go to a very quick one-liner or one-statement response. From Sean, our audience, gold or crypto under the current inflationary environment? Both to Patrick and Will, please. Gold or crypto?
Gold. Yeah, gold, because you know, they don't make more of it. Crypto, they're making more of it. Inflation is about you know, too much money chasing too few things, or too few things and too much money. Gold as inflation hits. So back to that point, you know, real assets over financial assets in terms of an inflation hedge.
Well, your view?
I would disagree with that, Patrick. I would say, you know, crypto, just because, you know, that it's just a very small pool, and there's an increasing institutional and investor interest in that. So a small reallocation of capital can drive up these you know, prices, you know, for Bitcoins by a lot more. Yeah, but that's a shorter term structural view. Yeah.
And we also have a good questions I would like to bring to the panelists to answer. We do have Yvonne from the co-chair of Young Professional Committee of Canadian Chamber of Commerce. She would like to ask questions for her colleague and committee members. How would young people today improve their foundations of financial literacy and contribute to a more inclusive financial system? What do you think in the financial industry today and policymakers can accelerate more of inclusive finance and more equitable system? And this is a question from our Young Professional Network, please.
Well, I would say, you know, again, you know, it's a complicated answer. You know, I mean, no one on there is going to do justice to it. But on one hand,
it's not fair.
Be,
to be fair. Yes.
You gotta, you know, on one hand, right? On one hand, you know, you got to think about, you know, obviously, you know, I want you to plan their future financially. But on the other hand, you know, there's almost too much speculation, right? Too much focus on, you know, trading, right? You know, so and it often leads to you know, unintended results, right? As we've seen, you know, with people trading too much, too fixated on finance, on asset prices, on stocks.
Yeah, look, I would say I think financial literacy is probably stronger than it's been any time that I can remember. You know, a number of young people out there that are talking about cryptocurrencies, or GameStop, or AMC, what's that, American Muscle Car, or any of those other stocks. You know, I think it's much higher than we've seen before, and I think that's a good thing. Perhaps it's not a good thing that people are chasing, you know, financial assets, you know, just you know, without you know, a good foundation. But I think we're on the way to. I think financial literacy is you know, is improving all the time.
There was another really good question just came through. Not going to be easy to answer within a short phrase, but I would still like to try it. From CPPIB, we do have the audience asking, currently with the recent volatility in Asia market affected by the US rates, historically the correlation between both have been low, no longer the case now. What's your opinions on that, and how would that affect future changes in the market?
Yeah, I'll jump in first. Look, I think that's right. I think that there's not been a you know, a high correlation or a strong correlation between, you know, Asian markets and what's happening globally. But I think it is becoming more integrated now. I think we're only going to see more of that. Will's been talking, you know, a great deal about the, you know, the cost of capital, and I think that's a very important point, you know, going forward. So I think as we grow towards more financial market integration, financial market maturity, you know, out of it and into China, then I think we will see more greater, you know, intermarket, you know, relationships tighten up.
Yeah, I totally agree with that. You know, I think partly the Asia volatility was also, I think on this, you see a correlation, right, with U.S. rates, you know, yields going up in February, and then that was you know, coincidental with the Asia market, you know, volatility. You know, part of that was also because, you know, right after Chinese New Year, some of these, you know, kind of a favorites, right, you know, white horse stocks, you know, started correcting, you know, the Chinese Baijiu names. You know, when you look at China rates, you know, they still stayed, you know, very much, you know, unmoved, right? You know, so I think, you know, it certainly affected sentiment. That was probably the primary channel for transmission, right, in terms of how U.S. yields went up, and then led to a kind of, you know, our coincidental, you know, with the Asia market volatility.
Lastly, given in the essence of the time, I would like to firstly thank all the audiences for all your very active, engaging questions. Some of the questions were really interesting, of which I personally would like to find out the answers to. So thanks all the audiences. I will also encourage all the participants today on the call, on the webinar, please do submit your additional questions or feedback, and those you see in the Canadian Chamber of Commerce should be able to provide our members in the future events. We at the committees are always here to help, to organize, and to source all the relationship we have in the market to provide up-to-date intelligence. So please do submit any of the requests that you have for us to organize for future events. And I will also further like to thank you both Will and Patrick today on a very intellectual and very insightful conversations. We do wish to have both of you back with us in the future events. Lastly, we do have the lucky draws for the audiences today. Earlier, our CanCham have drawn up 2 lucky winners. One is our Canadian current member, Cassandra Lister from the National Bank of Australia. The other one is our non-member, Max Berger from Golians Limited. Both of you have won and are the winners of our lucky draw. The team of Canadian Chamber will be in touch with you both. The panelists and the speakers today on the call, on the webinar, myself, as well as a donor, I believe it's from Ted Lee, and perhaps also our co-chair Alex may be joining too. So thank you all, and thank you both the lucky winners to join us on the webinar today. If any last statements that Patrick or Will would like to provide to our audiences, please free to do so. Otherwise, we'll also conclude our webinar very shortly.
I'd just like to say thank you for organising and all the participants. And I see on the chat someone asking for an email for the questions, and you know, for sure we'd be very happy to take any questions or queries offline and talk more about it. So, but thank you very much.
Yeah, same here. Thank you to Marianne, to the Chamber of Commerce of Canada, and really enjoyed the discussion we have, and really looking forward to future opportunities to discuss more.
Would love to have both of you back with us. Thank you, and have a good day, everyone.
Bye-bye.
Thank you. Bye.